Current policy, 100,000. So buffer inventory. Buffer inventory equal to reorder level minus lead time. Buffer inventory equal to reorder level minus lead time usage. Right, so for information, whenever the inventory falls to the buffer reorder level, then you need to place the order. So the reorder level in this question is 35,000 minus 2 weeks lead time, multiply 625,000 is annual demand. Annual demand 625,000, reorder level 35, and then how many weeks? 2 weeks lead time. So the time lag between placing an order and receiving the goods. So in this case, the buffer inventory equal to 10,000 units. Working number 1. And then working 2, EOQ 2 multiply per order 250 multiply 625,000 over 0.5, and EOQ is 25,000 units. Annual cost. Annual cost equal to current ordering policy and EOQ quantity. Current policy is 100,000 units, and EOQ would be 25,000 units. Annual holding cost. 2 column, 2 workings. Annual ordering cost, right? So 2 as well. Then sum up. $0.5, 100,000 over 2 plus buffer 10,000 units. Same thing goes to the second column, 0.5, and then EOQ 25 over 2 plus buffer 10,000. $250 per order and 625 over 100,000, and then 250 625 over 25,000 per order. So quite easy and straightforward. 0.5 multiply equal to 30,000, and then 11,250, 1563, 6250. $31,563, and then $17,500. Net saving 14,063. Net saving 14,063.